This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Avril Hong in Singapore. The top stories this hour. Asian stocks poised to follow Wall Street higher as further evidence of a cooling U.S. jobs market strengthens bets on a Fed rate cut next week. Treasury yields falling along with the dollar. French President Emmanuel Macron arrives in Beijing for a visit to be dominated by tensions over Taiwan and trade. And Meta poaches Apple's top design executive, underscoring the social network's push into AI-equipped consumer devices.
We've just opened for trade this Thursday morning in Australia. We've got the ASX posting some modest gains at the moment, better by about 0.25%. We are seeing the materials sector doing pretty well, leading gains in fact, and we've seen a pretty strong rally in a number of key commodities, including copper and silver warehouses. Silver continues to push forwards to a fresh record, copper at a record as well. We'll be keeping an eye on energy as well, also performing strongly in the Australia session. That sector better by 0.9%, because we've got natural gas futures touching $5 for the first time since 2022. We'll bring you a little bit more on that in a moment. Take a look at Nikkei futures. Meanwhile, pretty flat at the moment. We do have another key bond auction today out of Japan. That's the 30-year auction. We did see a JGB 10-year yield ticking up a little bit on Wednesday. Continues to be a bit of caution around Bank of Japan tightening and that incoming fiscal spending as well. But Avril will also be watching chip makers, of course, because they were pretty much the only ones that didn't get to participate in the Wednesday rally in the US.
Yeah, chip makers watching the Mag 7s as well. We heard from Microsoft and how they seem to be tempering some of these AI expectations. So worth noting how the Mag 7s underperform, but the rest of the market, most of it at least, actually managed to clock those gains. And we saw the smaller cap stocks actually doing pretty well. Now, you talked about some of the data that's come in. We, of course, had those payrolls showing us that at U.S. companies, jobs fell by the most since 2023, so signs of that weakening jobs market. And as these yields in the U.S. on Treasury slide, the dollar experienced its worst day since September. So we're also going to be watching, on top of yen, what we saw on the Chinese currency. We did see offshore yuan pushing up against the fresh highs for the year. Lots to unpack. Let's get more on the market outlook with Bloomberg and Life strategist Mark Cranfield. So Mark, what's top of mind for you?
All of the above. But let's start with the yuan. It immediately shows you the issue from a weak dollar, what it means for Asia. We're going to find out very quickly this morning because of the big moves overnight in currencies, particularly led by the euro. The euro is a very key currency for everybody in Asia. It's in the basket of all of them. It's a very big component. So the yuan, the offshore yuan, was outperforming last night, and it already means that the dollar against offshore yuan is lower than where we last saw the trading for the onshore market. PBOC will probably have to come in pretty hard at the fixing today to remind traders it's just going too quickly. They'll have to, when we get the estimates today for where traders see the yuan fixing, we will probably find that the PBOC puts the rate quite a bit higher than what the traders are anticipating, just to remind them it's okay for the yuan to get a bit stronger, but it has to be gradual. They can't have the offshore yuan leading the onshore. That's just not in their scenarios. It's going too quickly for them. Eventually, it's probably going to get to 7, but they want it to get there in their timetable. Too fast, and they will probably get a big pushback today at the fixing.
Mark, could it get a little bit of help from a weakening US dollar potentially, because we got that rather soft ADP payrolls report? Safe to say that Fed easing next week is pretty much a done deal?
Yeah, if there was any Fed people who thought they might be looking to go on hold or dissenting next week, I should think that the jobs data pretty much erases all of that. Now, the question really from a trader's point of view is, obviously there are 1 or 2 people on the Federal Reserve who are looking for 50 basis points cut, more than the 25 that was agreed the last time. The discussion's clearly going to be on the table. Now, will more people skew towards 50 than 25? It's pretty, from a trader's point of view, it's a a done deal, there will be a lowering of rates next week. Now the question is the magnitude. Will they go for something even bigger because those numbers were pretty bad, or will they say that the numbers are out of date, there's not enough in them to really base them going on for a bigger cut? But clearly it's now, the debate is going to be pretty hot between now and the FOMC. Does the Fed need to go for an even larger interest rate cut than is expected? But there won't be anybody dissenting after what we've seen in those numbers there. There's no room for that. Plus, in the background, you've got this discussion about when will they name the next chairman of the FOMC.
Yeah, and we are hearing how Bessent, interestingly, might be the next NEC chair. Does that put further weight onto the idea that Hassett is going to be the next Fed chair? And what does that mean for the rates outlook then?
Certainly, if you traders will be putting one and one together, and they'll be thinking, yes, that adds up to Bessent gaining even more power. And clearly that's been the theme ever since Scott Bessent became Treasury Secretary. From an investor's point of view, they actually see him carrying a lot more weight than even the chairman of the Federal Reserve. And that's backed up by the way they're using fiscal policy. We've done some studies. Simon White, our colleague in London, has written a very good piece recently explaining how under Scott Bessent there's more fiscal stimulus than there's ever been since Janet Yellen was at the Treasury. And those are considerable numbers. So really, if you're a global investor, what you're looking more at what is coming out of the US Treasury than you are from the Fed to some extent. And if Scott Bessent gets even more power, that will just cement what is already a view that people have, is that you need to watch what he's doing as much as you do on monetary policy. So yes, it's quite possible that if Hassett goes, then Bessent will be upgraded as well.
Mark, let's talk a little bit about what we saw on equities markets in the US today as well, because it's pretty interesting. You know, a decent rally on the S&P, very broad-based, and the only ones to miss out, really, were those big tech names. Is this a healthy rotation?
Hopefully. I mean, that's what global investors will be thinking, is that, yeah, this market goes up and you've got some rotation without the Mag 7 being involved on the surface. That looks healthy. They will be concerned about what NVIDIA had to say. Jensen Huang was saying that even if there's approval, China might not take up his chips. That's a big one for people to digest over the next few weeks. Because if the China market is not open to these major companies, it will cap their ability to be able to make money, particularly out of, I mean, the AI story has been concerning people for a while. There's formed a bubble. There's been too much investment, overinvestment in that space. And if NVIDIA is on the verge of saying, well, we've reached capacity, that's a warning signal right across the space.
Mark, always fantastic. Thank you for your perspective. Mark Cranfield, Bloomberg MLive strategist. And there's more ahead on President Macron's visit to China as well, when we're joined by the Atlantic Council in a few minutes. Also coming up, PGIM tells us why bond markets are in a strategic buy zone, and Mizuho Securities weighs in on the outlook for China's property sector. You're watching the Asia Trade. This is Bloomberg.
Commerce Secretary Howard Lutnick said the US is expecting a large investment pledge from Taiwan in upcoming trade talks. Taiwan's President Lai Ching-te, however, outlined areas that need improvement before investment projects can be completed. So let's get more on this from our China correspondent, Min Lo in Hong Kong. So Min, what's the spend here that's being sought by the United States? And is there a tacit suggestion that perhaps this is the price of ongoing US political and military backing?
Yeah, Howard Lutnick certainly saying that he is seeking this investment pledge, and he hinted that it could be topping $300 billion. Not clear if that amount would include the amount that had already been pledged by TSMC. They already announced the ramping up of production in Arizona. That investment already at least an increase of $100 billion. But certainly there seems to be a price tag here that Howard Lutnick is suggesting. And Lai Ching-te on the the other hand, in a video recording that was played at a summit hosted by the New York Times, is pushing back against this, saying that whether or not Taiwan can hit the 40 to 50% target that Howard Lutnick has set when it comes to onshoring chips production, he said that would depend very much on U.S. assistance when it comes to land acquisition, when it comes to electricity and water supply, and so on, talent development, other investment incentives. So he's both sides. It's a bit of a tussle here, but we know that Taiwan has been looking to reduce the tariffs that is imposed on its goods from 20% to 15%, and of course this is coming amid this tension that Taiwan is at the center of between Japan and China as well. And recently, just last week, Taiwan, the President Lai Ching-te had penned an editorial on Washington Post announcing their plans to increase their defense budget by $40 billion. That clearly seems to also be a response to President Trump's criticism on the campaign trail, calling for Taiwan to spend more on its own defense as well.
Min, Taiwan is also in focus with Macron in China.
That's right. Macron is in China for this 3-day visit. And interestingly, we're already getting lines from the Chinese Foreign Ministry that Wang Yi spoke to his counterpart, French counterpart in Beijing, telling him that he hopes France could understand China's legitimate position on Taiwan and that both France and China should work together to prevent Japan from stirring trouble in this region. And just ahead of Macron's trip to China, Wang Yi also had a call with Macron's diplomatic advisor, sending the same message. And soon after that, a Japanese national security advisor also spoke with Macron's diplomatic advisor, and both sides, Japan and France, had reaffirmed their close ties, talking about expanding security cooperation and committing to this free and open Indo-Pacific. So clearly Macron is walking a very fine line here, trying to balance between the interests of China and Japan. He's there, of course, to also seek for, China to back down on those probes into French dairy and pork products. Those probes had been in place and could potentially lead to more tariffs, and that was in retaliation to the EU tariffs on Chinese EVs. And France had been a key player at that time in shaping the EU opinion that eventually led to those tariffs.
All right, Bloomberg's China correspondent Min Lo there.
Much. Now, we are watching other bilateral meetings as well, of course. It's not just about Macron and Xi. We're also keeping tabs on this Putin-Modi meeting. And it's worth noting this tale of two currencies, right? We talked about this earlier in the program with Mark Cranfield. China has been guiding the currency stronger, and it's pushing up against these fresh highs for the year. But this is also coming against the backdrop of the dollar weakness that has not been quite supporting the Indian rupee. We're seeing it record lows despite intervention from the RBI. So that's something that is worth keeping tabs on as we watch these bilateral visits or meets as well. Paul?
Yeah, on that topic, the Russian President Vladimir Putin set to arrive in India later today for his first visit since Russia's invasion of Ukraine. The trip comes as sanctions and US pressure seek to curb an energy trade vital to Russia and also critical to India. Let's get some more on this with Bloomberg's Michael Heath. So, Michael, plenty for these two to discuss. What's on the agenda?
Yeah, Paul, I mean, to some extent, they're wanting to project a sense of continuity despite all of the issues you sort of mentioned around there, and there is obviously a lot going on. I mean, that this relationship goes back to Soviet times. It's more than half a century old. And for Russia, it's really important because it shows that basically while it's locked out of Europe and the US, that it still has, serious world powers to deal with, like China, like India. It's a big arms supplier to India. It's been supplying India crude. So these sort of issues will be discussed. And for India, particularly after its skirmishes with Pakistan in May, it's keen to get more arms from Russia, particularly the S-400 air defence and potentially even the new version, the S-500, as well as more aircraft. And at the same time, it always has liked to have Russia or the Soviet Union as an ally, just to sort of counter China somewhat. But that's sort of a little bit more complicated now because of the shutdown of Europe for Russia. Russia's become very dependent on China, so Russia's sort of trying to balance those two as well. So there's a lot of jockeying going on, and in the background you have President Trump, who wants India to stop buying Russian oil and has increased sanctions. So there's a lot of atmospherics around there.
Yeah, Mike, I was just about to ask you, how much of a risk is India taking in hosting Putin? How might this be received by the Trump administration?
Yeah, it's going to be really interesting to see, Avril, because perhaps 3 or 4 months ago it would have been more problematic than now. Obviously, President Trump met with Russian President Putin in Alaska a while back when he was trying to settle or find a way to get a peace deal going with Russia and Ukraine. So that's broken the ice somewhat. I mean, Putin has been very isolated in terms of visits to other countries. There's obviously an international warrant for his arrest over child kidnapping from Ukraine. There's a prosecution out there for him. But with India, I think the US sort of understands that there is that long-term relationship there. So it's sort of almost on what President Trump's mood is at the time. I mean, he has been pressuring over Russian oil purchases by India, yet at the same time he seems to have pivoted back to being more supportive towards the Kremlin in terms of the whole Russia-Ukraine deal. He's sort of pressing Ukraine to accept Russia's terms, even though Russia's terms are quite going to be very, very difficult for Ukraine to accept. So that's really a bit up in the air. We'll just sort of have to watch what Washington's position is. But at this stage, because of that earlier summit, I think it probably clears the path a bit for Indian Prime Minister Modi to not get too much blowback from Washington.
All right, Bloomberg's Michael Heath, thank you. Let's get to the top global headlines that we're following. We've got the European Union putting forward 2 options to shore up Ukraine's war-strained budget. It's either a loan backed by frozen Russian assets or one guaranteed by the bloc's own budget. Under the plan, Ukraine would receive 90 billion euros, but officials warn the country will need more over the next 2 years to keep basic services running and support its military. Beijing has rejected the Russian assets option, citing concerns it could be left to repay the loan alone. Hong Kong has ordered all buildings undergoing major repair work to immediately remove exterior scaffolding nets. The move comes as authorities investigate suspicions of forged safety certifications after last week's building fire that killed at least 159 people. Officials earlier said the rapid spread of the fire was linked to substandard scaffolding nets and the use of styrofoam boards. More ahead on the Asia trade. This is Bloomberg. Bloomberg has learned that Meta has poached Apple's most prominent design executive. This is a major coup as the social network accelerates a push towards AI-enabled consumer devices. Let's get to San Francisco now and our senior tech editor, Nick Turner. So, Nick, Meta has poached Alan Dye. Can you tell us a little bit more about who he is and how significant this is?
Sure, yeah. I mean, he's been at Apple for almost 20 years, and at least since 2015, he's been kind of leading efforts to develop interfaces at Apple and really touched any number of products, including obviously the iPhone, but the Apple Watch, the Vision Pro headset from, which was released last year. So just a real influential person at Apple, and someone that a few years ago you would be shocked to go to Meta, which of course it was more famous for social media than devices.
Nick, does it speak to Apple's inability to keep some of its top designers? I mean, was it a couple of years ago in 2019, it also lost another?
It's been sort of, I don't want to say snowball, but Johnny Ive, of course, was this visionary designer. He worked with Steve Jobs. He really kind of created so many of the products that we associate with Apple. And when he left in 2019, a lot of people followed him out the door. It's kind of forced Apple to rebuild their design group and figure out what they're going to do next. But Tim Cook did say earlier this year that design is really, he kind of reasserted that design is absolutely core to what Apple is doing. And it seems like they're really sort of in a rebuilding mode at the moment in terms of getting their design back in good shape.
Nick, what do we know about what he might bring to the table at Meta then?
I mean, it's an interesting question. He's working at the Reality Labs division, which is the one that does VR headsets and these new smart glasses that are actually fairly popular, at least among early adopters. That's certainly, I think, the big moonshot at Meta is creating an augmented reality glasses, spectacles that would really sort of become a mainstream product. And presumably he's going to be helping work on that. Mostly the design for those products comes from Ray-Ban at the moment. And so I guess we're just still maybe kind of a wait and see mode in terms of figuring out how he's going to influence the way they design some of those products.
So what's going on at Apple? I mean, you mentioned this is obviously on the radar of management, that they're losing talent. How do the ranks look?
Apple is in a funny position. I mean, in terms of its AI, it's certainly lost a lot of talent this year, a lot of it to Meta, in fact. But it's also at this point with its executive suite, where a lot of the executives are around the same age. They're sort of in their 60s. Tim Cook just hit 65. So there's obviously growing speculation that some of them are going to leave eventually, and they will, but it's a matter of when. It's just that the company's executive ranks happen to be sort of clustered around a certain age. So it seems like we're going to see a lot of people leave around the same time.
Ooh, succession planning sounds like part of the conversation as well. Nick, thank you so much. Our Bloomberg Senior Tech Editor, Nick Turner. Now, here are some other stories we're tracking in the tech space. Shares of Microsoft fell in New York after a report of weaker demand for some of its AI tools. The information said several divisions at Microsoft have cut quotas for how much salespeople are expected to boost sales of certain AI products after many missed their targets. A Microsoft spokesperson has denied the report, stating that the aggregate sales quotas for its AI products have not been lowered. NVIDIA CEO Jensen Huang says he's unsure whether China would accept the company's H200 AI chips if the U.S. relaxes restrictions on sales of the processors. Earlier this year, NVIDIA won approval to sell its less powerful H20 chip in Beijing, designed to fall just below existing export limits. But China promptly told potential domestic customers to shun the product and rely instead on processors made by Chinese companies. Binance has appointed co-founder Yi He as co-CEO. It's the most significant change to the crypto exchange's top leadership since Changpeng Zhao stepped down 2 years ago. Yi He is credited with driving the growth of the Binance-initiated BNB chain and has overseen the firm's institutional client business as well as acquisitions such as CoinMarketCap. Now, as we track these geopolitical moves in tech with AI really front and center, as the European leader Macron heads to China and speaks to the Chinese president, it's really interesting how this rivalry has shaped up. That's something to watch as well. But really, when it comes to U.S. tech, overnight we did see that bit of rotation. When it comes to the Mag 7s, we heard from Microsoft, and this idea of tempering AI expectations and focusing on the payrolls numbers, right? So bad numbers, so bad that it's become good. But the extent in which that's supporting the broader markets, we are actually seeing, interestingly, the smaller caps. That's where the pickup has been, the Russell 2000s. So the riskier corners of the market have been rallying while big tech has lagged. And this rotation appears to be gathering pace into December. That's the dynamic you're seeing on this chart. We have more ahead on the Asia trade. This is Bloomberg. Now, amid the bad data on payrolls, Private numbers out of the U.S. showing us a weakening labor market. We are seeing the dollar following on from its worst session since mid-September, looking fairly steady, but that is at play when it comes to some of these Asia currencies, including the Chinese yuan, which has been pushing up against some of these records for the year at least. So that is at play, along with what we're seeing on the euro versus the greenback as the French president lands in Beijing, Paul.
Yes, Emmanuel Macron landing there on his first stop. It's a 3-day state visit to China, and his last trip to China 2.5 years ago was overshadowed by remarks that appeared to limit his commitment to supporting Taiwan. The island is once again in the spotlight. China is now seeking backing from France in its dispute with Japan over Taiwan's status. Joining us now is Zoltán Fehér, geostrategist at the Atlantic Council's Global China Hub. So, Zoltán, thanks for joining us. A high-stakes meeting for both countries here, and Emmanuel Macron really getting the charm offensive in China over the next 3 days. Can you paint us a picture of what a successful visit looks like for both Macron and Xi Jinping?
Thanks for having me, Paul. It is hard to imagine a successful visit for both sides, because both sides want very different things. And as you mentioned, President Macron paid a visit to China 2.5 years ago, and President Xi Jinping paid a visit to France, reciprocating Macron's visit in May 2024, so a year and a half ago. So this is the continuation of their series of visits, and they usually have things that they agree on, and they usually have things that they don't agree on, and this time is no different. I think even though Macron did give also Xi a charm offensive in May 2024, and Xi seems to be giving the French president a charm offensive this time, I'm afraid that disagreements will remain even after the visit.
Yes, it's a difficult trip for Emmanuel Macron because he's dealing with potentially 3 important partners here, none of which he wants to upset, China, Japan or Taiwan. How does he walk this tightrope?
It's difficult, and Macron has been walking this tightrope for many, many years. He's been in office since April 2017. He's built a relationship with Chinese President Xi Jinping, and they have paid many visits. They've met many times, and they've discussed different issues that where they agree on, issues where they disagree. This time may be a little more tense than previous times because of the Japanese Prime Minister's recent statement about Taiwan, when she said that if China invaded Taiwan, that would mean a geopolitical problem for Japan as well. And she implied that Japan would get involved militarily in such a conflict. And so Macron is expected by the Chinese leadership to distance himself and France from Japan. That is very unlikely to happen, given that Japan is an important security and trade partner to France. And to preempt that, the French government held talks with the Japanese government yesterday, where they discussed these issues, and France called Japan a key security partner.
Zoltán, this is all coming against the backdrop of perhaps some mixed signals as well when it comes to the EU and how it's restricted Chinese access to tech and investment. So how does that square away with what any form of success might look like then?
It's a difficult juggling act for Macron, but he's been doing this juggling act for a while. He wants to do 2 things this time, and he's wanted that for the past few years. he seeks to rebalance the heavily imbalanced France-China trade relationship. But he also wants to maintain robust economic relations and political rapport between the two countries. And that's really, really difficult. France has chosen an interesting strategy within the European Union. They try to intensify bilateral relations in the economic sphere with China, while they're pushing for tougher EU-level steps, sanctions, trade tools, because we know that the European Union is a trade bloc. The individual countries cannot impose tariffs on other trade partners. So France has pushed the EU to use those trade tools, including tariffs. France and personally, President Macron was one of the leading voices that pushed for the EU's tariffs on Chinese electric vehicles.
It's also about the future competitiveness of Europe. How relevant is all this? Because we know that currently as an AI player is not a strategic one when it goes up against the US and China. How might that affect the sort of leverage or the conversations that Macron might be having?
The EU and within the EU, France are in a difficult position because, as you mentioned, Avril, the United States and China hold the technological cards. Unfortunately for the Europeans and the EU, Europe is not a leader in the tech sphere. So it needs very much American technology and Chinese technology. This is why, even though the EU has been trying to so-called de-risk from China for years, especially driven by the Commission under Ursula von der Leyen, but it's difficult for the European Union to de-risk and distance itself from China economically, because it does need Chinese investments and it also needs Chinese technology. So in terms of the AI sphere, there's a competition between the United States and China for leadership, and unfortunately, the EU is not among those running for that title. So it needs to get technology, semiconductors, AI chips, advanced chips from the United States, and it needs to get technology from China. So it's doing this balancing act currently to stay on the good side of both while advancing so-called European strategic autonomy.
Zoltán, there's also an expectation that Emmanuel Macron would raise the Russia-Ukraine war with President Xi, although is it realistic to expect any movement in China's position on that?
No, it's not realistic to expect any movement in China's position, but President Macron will raise it again. He's raised it before in phone calls, in meetings. He raised it during President Xi's visit to France in May 2024. Without any success. He's going to raise two things related to the Ukraine war. He would like the Chinese leadership to pressure the Kremlin towards ending the war in Ukraine. And it also wants to call on China to stop supporting Russia's war in Ukraine. As you know, the European Union has officially named China a key enabler of Russia's aggression against Ukraine. So President Macron has every right to raise that. And this is something that the leaders of the European Union raised in July 2025, this past summer, during the EU-China summit, when they said to China, if you want to be friends with us, then you cannot support a war that is threatening our security.
Right. It's going to be really interesting to see what we actually get out of this visit. Zoltán, thank you so much. We appreciate your time, your analysis. Zoltán Fehér is geostrategist at the Atlantic Council's Global China Hub. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how commodity prices are faring, of course, tracking oil. We have some geopolitical volatility affecting prices, of course, when it comes to what we got from the US and Russia in relation to the invasion of Ukraine. Those talks don't seem to have amounted to much. We are seeing, though, U.S. crude futures pushing up on that 59 level. Now, natural gas is also in the spotlight. I think there's some sense that we could see $5 on natural gas. Steven Stupczynski, who leads our Asia energy coverage, joins me now. Put things in perspective. What are we watching when it comes to natural gas? Why is it suddenly moving as much as it has?
So there are a few factors for U.S. natural gas, Henry Hub futures as they call it. And, one, I think, of course, is, okay, there are some short-term weather effects, right? We're heading into winter, colder weather forecasts. At the same time, there is this view that AI could increase gas demand kind of long-term. But I really want to focus here on liquefied natural gas exports. This is particularly important because the U.S. is already the world's biggest LNG exporter. But over the last year, and I've crunched the numbers recently, if you look at the amount of exports that the U.S. has, it's up 40% year on year. There are projects ramping up faster than expected. There's another project that's about to start up in February, a very large project called Golden Pass, that will further increase LNG exports out of the United States. So there's this interesting dynamic where Henry Hub, the U.S. gas benchmark, is rising, but the U.S. is flooding the market with LNG, and that's helping to push down gas prices in Europe and Asia, which had been much higher than the U.S. Since the invasion of Ukraine in 2022. That really pushed up global gas prices. So we're getting to this convergence where U.S. gas prices are rising higher, Europe's falling, and where do they meet? And will U.S. gas prices stay higher? That's the big question, because the U.S. also has a lot of shale gas. They have a lot of production capacity. So will this rank up in prices result in a prompting of drillers to put out more rigs? Will it also potentially reduce demand for U.S. LNG potentially in the future if the prices are too high? Because that price arbitrage, that price spread is shrinking. Your profits are shrinking as well. So the U.S. gas story is very fascinating, and it's something that I think the market global will be watching very closely.
Stephen, the dynamics in the gas market, as you're unpacking there, very, very interesting. But can you explain to us the dynamics underpinning the oil market at the moment? Are they somewhat simpler, with Russia, Ukraine, as usual, casting a shadow over it?
Yeah, I mean, I think one thing that had been come into focus over the last month or so has been whether there can be some sort of way that the Trump administration can broker a deal. And, I think there are a lot of unknowns, but clearly if there were some sort of peace agreement, then you could see maybe a rolling back of sanctions, right? The Trump administration hit Russia kind of by surprise. Their two biggest producers, Lukoil and Rosneft, recently, and that kind of shocked the market. It forced Asian buyers to kind of try to scramble for different supplies, and that's sort of tightening things. But if there is a peace deal, there are expectations within the market that potentially those sanctions can be rolled back, or more Russian oil can kind of flow into the market. And we're already facing a bit of an oversupply anyway with the fundamentals. Now, we look at the talks between the U.S. and Russia just earlier this week. It doesn't look like we have a breakthrough. There was progress, but no breakthrough yet. So I think that's why you're seeing kind of prices up, sort of steady over the night. And, I think that's something the market will also be focused on going forward, because Trump is a wild card. Who knows how quickly he could pull a deal together. The Ukraine war will not be an easy one to broker a peace deal for, but I think time and time again we've seen that Trump has been able to surprise.
So we have a bit of that geopolitical volatility picking up in prices for oil. Is that something that we should be watching when it comes to gas? I mean, you talked about the demand picture.
Yeah, I mean, I think absolutely the geopolitical situation for gas is the same almost. I mean, there are different fundamentals playing into. Now I'm going to focus on international gas prices, not the U.S. On Asian and European gas prices. Yeah, if there's a brokered peace deal between Ukraine, Russia by the U.S., then you could also see a rolling back potentially on sanctions on Russian LNG. Arctic LNG 2 has been producing below capacity. It's a very big LNG export plant in Russia's north because it was sanctioned by the Biden administration. Will that be something that will be rolled back? Woodmac analysts think it could be. Also, it reduces the risk of future sanctions on Russian LNG if there is some sort of peace deal. So that reduces that risk. There's still a risk premium in the global gas markets. So again, that could mean a leg down for European gas and Asian gas prices. And then what does that mean for U.S. gas? That spread further shrinks. Does that mean that U.S. gas prices also have to fall? We're in this very sort of unknown territory where we're kind of converging on these two prices for the first time in 3 or 4 years. And it's going to be really fascinating to see how it plays out.
All right, Stephen Stapczynski there, who leads Asia energy coverage. Thank you. Let's take a look at how Bitcoin's doing. Better is the short answer. We are seeing somewhat of a recovery at the moment, but I guess the key question is how sustainable is this going to be? Technical analysis suggests that the downtrend may still be firmly intact, and this gets even more interesting when you price Bitcoin and gold, and this is always an interesting test. If I would offer you 1 Bitcoin or 22 ounces of gold, which one would you choose? Let's get to Bloomberg's cross-asset reporter Richard Henderson now. Richard, with that in mind, what's the outlook for Bitcoin here?
Definitely, yes. So Bitcoin is back. We're trading above $93,000. That's US dollars per Bitcoin. And, this has really bounced off the lows in around the 80s in the last few weeks. So we're at about a 2-week high now. Part of it is sentiment driven. We did have this big sell-off from a high of around 126,000. And so we're getting a little bit of a rebound there. You've got to keep in mind, though, Bitcoin is such a sentiment driven asset, and so what we're seeing overnight in the US with weaker jobs data supporting the case for Federal Reserve cuts, that's adding some heft to a global risk rally, and that's seeing Bitcoin climb as well. So it's a bit of a bigger picture, but this is such a volatile asset class generally that it's hard to make too many predictions over the medium or long term. But obviously we are seeing a bounce in the price of Bitcoin, which suggests that traders are, seeing some further gains to be had in the near term.
Richard, what does this mean for other assets? I mean, we saw how, despite earlier in the week that bounce back in Bitcoin, stocks still seem to be unconvinced or lagging.
Yeah, we got a little bit of uplift overnight in US stocks. That's during the Wednesday trading day in New York. But it is still a little uncertain. The central bank outlook, what the Fed is likely to do. Traders now pricing more than 90% chance of a Fed cut in December. So that easing is very supportive of stocks, which, traditionally, all things being equal, does typically increase sentiment and can add lift to Bitcoin. But it's been such a volatile asset class this year. It's hard to make that sort of directional bet, but definitely overnight seeing Bitcoin rally back above 93,000 US dollars per Bitcoin, in line with those gains in US equities. That's giving us a sense in the near term that there is some support for the asset class, some more optimism coming in.
Richard, thanks so much. Bloomberg's cross-asset reporter Richard Henderson. More ahead on the Asia trade. This is Bloomberg.
Japanese banks are in focus as rotation into the sector accelerated this week, and this is after Bank of Japan rate hike bets rose following Governor Kazuo Ueda's comments. Let's get now to Aya Wagatsuma, Japan equities reporter in Tokyo. So, Aya, why are bank stocks gaining momentum?
Hi, thank you so much for having me. So bank stocks are currently gaining more momentum at the moment because the Bank of Japan, they will be having a decision rate hike with this month in December, and there is a potential for them to have a rate hike in December, and that would mean that it would benefit bank stocks a lot more. So now a lot of attention is going to banking stocks, and there's currently a rotation going on into banking stocks from chip stocks at the moment. Yeah.
What are you seeing in those chip stocks, Aya?
So chip stocks at the moment are becoming a lot weaker at the moment. Chip stocks have been gaining on this AI boom, and it has been rallying for the past year. But now that there has been kind of a concern over a AI bubble, there are people that are a lot more concerned about semiconductors, chips, and AI, and therefore a lot of people have been looking into banks, which are steadier, and also with the Bank of Japan policy decision coming up as well this month, everybody is now looking into that part of this sector.
Yeah, normal rates going to mean some better net interest margins for banks as well. But what are the risks here for the banks?
So for the risks for the banks, at the moment, there has been longer bond yields in general in Japan have been going up, and the 10-year yields are currently near a 2008 high, and there have been concerns that should the yields go up much higher, then there would be a risk to the banking stocks and an increase in securities valuation losses. So therefore, having a high interest rate is good for banking stocks, but at the same time, too high interest rates would be very bad for banking stocks.
Aya, thanks so much. Our Japan equities reporter, Aya Wagatsuma. So those are the sectors that we'll be watching when trading begins in Tokyo. And for the moment, take a look at how Nikkei futures are faring, looking really flat. So I think this speaks to the sense that there isn't enough conviction in the markets at the time where it's not just about the weak payrolls. We're still waiting out for the Fed's preferred gauge of inflation. That's data coming out later in the week, delayed data. At that. So taking a look at the Asia picture, it looks pretty flat across the board. Now, a couple of other things as well that we are keeping watch on, including these currency moves as we see the dollar continuing its slump, even though it's looking quite steady in the Asia session. How might that play out into the picture for Japanese big caps in particular? Markets open in Seoul and Tokyo are next. We'll track the open. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens. And Avril, could be an interesting session today after what we saw in the US. Pretty broad-based rally that included most things with the exception of big tech.
Yeah, the Mag 7 struggled a little. We heard Microsoft tempering those expectations on AI. So it'll be interesting to see how that plays out among Asia AI chip-related stocks in the session as well, Paul.
Yeah, also had some weak ADP payrolls numbers out of the US as well, pretty much nailing on that there's going to be a rate cut from the Fed next week. The commentary will be interesting to watch, however, and we're seeing some interesting moves in bonds as well. We've got them open just coming up in a few seconds, so let's take a look at how the Nikkei is performing. Pretty healthy gain there, better by 1.14%, but take a look at the 10-year down the bottom of your screen. Above that 1.9 handle just, but that is the first time we've seen it there since 2007. And there's another interesting test coming up for Japan's bond market today as well. There will be a 30-year auction a little bit later on. And this is, of course, against the backdrop of caution about BOJ tightening, also likely, almost certain, incoming fiscal spending from the government as well. We're keeping an eye on chip makers also because, as I mentioned there, the tech giants stalled a bit today despite a broader rally elsewhere. So we're seeing the Nikkei now giving up some of those narrow gains, now better by just 0.1%. Now we've opened for trade in South Korea as well. We're seeing a few losses there at the moment. The Kospi softer right now to the tune of 0.4%, but the tech-heavy Kosdaq index also showing some modest gains. The Korean won, Avril, still pretty weak, though flat at the moment.
Yeah, when you talk about weakness for Asia currencies, this is really interesting backdrop, right? Despite the dollar still looking quite depressed. And of course, this is about the Fed's rate trajectory. December, as you say, is pretty much all baked in. But where do we go from here, especially in the first half of the year? And those considerations about who the next Fed chair is going to be. Does the idea of Bessent, based on reporting, being the next NEC chair, cement the idea that Kevin Hassett is going to be the next Fed chair and, build on these bets of a further rate cuts from the U.S. Central Bank? We're looking at the 2-year pushing towards the 3.48 level. Of course, that's the policy-sensitive side of things. The 10-year is nudging higher on those yields as well. Let's bring in our markets executive editor, Paul Dobson. Paul, it's time where I guess we are hanging on those private payroll numbers. That's influenced what we saw on Wall Street. But at the same time, there doesn't seem to be a lot of conviction in markets. What is this going to mean for Asia?
Yeah, morning, Avril. So I think in terms of the stock market, as Paul was saying, we started off with kind of modest gains, not a huge deal of momentum behind it, those reservations over the tech sector. But I think for the currency market, maybe there'll be a bit more strength coming through because of the weaker dollar on those Fed bets. So the market looked at those jobs numbers yesterday and thought, okay, so the Fed is right to be paying more attention to the weakening labour market and less worrying about the inflation side of the equation. It's 90% priced for this December cut, pretty much near certainty now. And that did drag down the dollar and kept those bond yields in the US, lower. I think that will be a relief for some of Asia's currency markets. Look at the Indian rupee, for example, which the central bank has been trying to defend around the 90 level. You see other currencies like the Korean won, like the Philippine peso, also been under pressure in recent weeks. So the idea that the dollar comes down releases a little bit of pressure for us. I think on the equity side of things, a little bit more uncertain, because most of our gauges are so tech heavy. But what we're really seeing in the US market is that the leadership is switching. It's not the tech companies that are driving us towards a record high. This time around, it's more biotech companies and other parts of the economy that are performing a little bit better.
Yeah, I guess, is this a moment where we pause, where even the likes of Morgan Stanley look to be reducing some of their exposure when it comes to financing data centers? Is that another part of headwind for tech?
Yeah, I think it tells you that there's still a little bit of a reservation about the bubbly risks that are there, about those valuations, about the amount of debt that's required in order to pay for everything that needs to be built and rolled out. On the plus side, there's still investments and investment deals getting announced at the same time. There's still positive momentum behind it. On the sort of longer term perspective, it's just, at the moment there's that little bit of a moment. I think, there was some stories last night about whether Microsoft is managing to meet its sales targets for AI. I think it came out and sort of denied whatever was in those reports exactly, but it's another one of those little sort of knocks or setbacks to the big tech as a in the round. I think there's a little bit of differentiation there as well, but in the round, there's holding people back from the sort of really gung-ho moves that we saw earlier in the year.
Paul, there was some concern earlier in the year as well that this rally was looking pretty lopsided. It was the Magnificent Seven and not much else. But now we've got a situation where more than 350 of the stocks on the S&P 500 had a really good day. Is this broadening a healthy sign for markets?
Definitely healthier, right? For so much of this year, it has been the big tech companies in the lead, increasing their dominance. That sort of idea that because of so much money going into broad indexes and their heavy weighting just means more and more capital gets pushed into the biggest firms there. So the idea that there is that broadening out should be, people like that sort of, they call it healthy breadth or whatever. They like the idea that it's it's more confidence in the sort of overall outlook. And I think the fact that the Fed is going to be cutting interest rates certainly helps for that broadening of the rally as well. The idea that the Fed is going to move in December, the idea that Jerome Powell is going to be replaced by somebody likely more dovish next year, which would probably, all things being equal, lead to more cuts in interest rates, might not be great for the inflation outlook, but should be great for the equities market.
What could derail that view on a dovish Fed, though? Are we possibly going to see a hawkish cut next week?
So I think that what we saw last time around was a pretty hawkish cut. You know, Powell was very clear in the press conference about the idea of two-way risk being injected again. And we've heard from a number of Fed speakers that they were uncomfortable with the cut last time around even. So it's going to take a little bit of, horseplay in order to convince the majority of the Fed to go in one direction. It does feel like the center has tipped more in favor of a cut, but I suspect that there will be some people that will vote to keep interest rates unchanged, and so that does create a little bit more uncertainty in an unstable environment moving into next year. And when the data finally catch up, because remember we're still in this sort of horrible position where everything is coming through with a lag because of the shutdown. When that catches up, we'll need to see where are we with inflation, where are we with consumer confidence, where are we with the poorest people in society, where are we with the labour market, and then the Fed will need to recalibrate its decisions moving into the year ahead.
The backlog on data among the complications for investors. Paul, thank you so much. Good to chat. Asia Markets Executive Editor Paul Dobson.
Well, let's get some more perspective on the fixed income markets now. And joining us from Hong Kong is Greg Peters, co-CIO for public and private fixed income at PGIM. Greg, thanks so much for joining us today. And I do want to kick off with that data that we saw out of the US, the ADP November payrolls slipping. Pretty much seems to be the consensus that that's nailed on a Fed rate cut for next week. But what kind of commentary do you expect to hear now around further easing?
Yeah, so I do think, we will have a hawkish cut, coming up. But I'm not sure there's a lot of information coming out of that meeting, right? I think the markets are focused on what happens next. And what happens next is the new Fed chair, the new composition, and quite candidly, the meddling of the administration in Fed affairs. So I'm not sure there's a lot you can read into next week's meeting. But the labor market has been softening. It's been stagnating for quite some time. You saw that in spades yesterday. So, on one hand, you have a weakening labor market. On the other, you have stubborn inflation. And our read is that inflation is going to actually be much more stubborn going into 2026. And that really complicates matters for the Fed and complicates matters for, financial markets writ large.
Well, in terms of 2025, we've got US Treasuries heading for the best year that they've seen in 5 years. But with the picture a little bit more interesting for 2026, how do you see this trend evolving?
Yeah, so if you decompose what has done well on the Treasury side, it's not the back end of the curve. So what has been happening is that even though Fed cuts have come through, it's pulled the front end lower and the belly lower, but the back end is actually trading higher today than it was this time last year. And so why is that occurring? Because investors are worried about this inflation component. They're worried about Fed independence / credibility. And so risk premium, term premium is being built into the curve, not only in the U.S., but across all sovereign bond markets. So it depends where you are. The bond market in the back end is still quite fragile.
I wonder on those back-end concerns, when it comes to fiscal and that idea that tariff revenue could help offset some of those woes, where are we on that, as we're also still waiting out for Supreme Court decision?
Yeah, so we're waiting for that ruling. Bottom line is those revenues might help on the margin, but it doesn't, solve the problem. And so I think either way, whatever the Supreme Court decides, the tariff desire is still there. So I do believe the administration will find ways to keep tariffs, still quite high. But it adds more uncertainty into the mix. It's harder to financially model debt sustainability, what the debt outlook looks like, not knowing kind of what the outlook for tariffs are. But tariffs is far from a panacea. And then on the other side of it, it affects growth. So it's coming out somewhere else. So just because you have a dedicated line to tariffs doesn't mean that that's just a one-for-one add-on of revenues.
That's a great point, Greg. Talk to us about where you see opportunities in credit. What are the right segments in your mind?
Yeah, so I think we're still in a challenged environment. Credit spreads are quite tight globally. The way we think about it is that we see the real opportunities in what we call safe carry. So that means, structured products. So we have a strong desire for AAA CLOs. We like short corporates, both in high yield and in investment grade. We just don't see a lot of value going out the risk curve. We think it's pretty expensive, and you're not getting paid for it. So it's about generating safe carry and not leaning into the risk, because there are a lot of risks on the horizon.
Greg, I just want to get your views on Fed independence as well. We've had a report in the Financial Times today about bond investors warning the Treasury about the risk of Kevin Hassett, should he be the next Fed chair, of pursuing easing for political reasons. I'm wondering if you'd add your voice to that warning, but also, when push comes to shove, is the bond market going to make sure the Fed stays independent?
Well, I sure hope so. So, I mean, the market has reacted since the betting markets have, raised the probability last week. The bond market has performed quite poorly. So the bond market's telling you that there are some concerns there. But on one hand, you have the Fed independence question, with Hassett as, basically tied to the administration. But on the other, does he have the credibility within the committee to drive consensus? And so we don't know that answer. I don't think he has that credibility. I think that's what the bond market is telling you. But it's important to remember that it's a full committee, and you have to have the confidence of the committee to drive consensus, and I don't know if he has it. But one point on that, though, I think there's a lot more to come on the Fed side. I think the Fed chair is just one aspect. I look for some other structural changes on the come from the Fed that actually whittles the independence even more than just having a different Fed chair.
Hey, Greg, just picking up on your point earlier about the segments of opportunity, something we've also been seeing in terms of credit issuance going gangbusters in plays related to AI. What is your sense amid these concerns about bubble risk? Is there a lot more to go on this into 2026?
There is. So what if you look out and see what's on the horizon as far as issuance is concerned, there's something like $5.3 trillion needed to get funded, right? About $1.5 trillion is coming from free cash flow. The rest has to hit the bond market, and it's hitting the bond market in the unsecureds, it's hitting in the private, it's hitting in the asset-based finance side. So, I think this is a story that has yet to unfold, and there is this concern on the revenues and the return on invested capital on the other side. So, the way I look at that, I think unsecured debt, so let's say just generic investment-grade corporates funding these data centers and this AI build-out looked like terrible value to me. But on the other end, there's construction loans that are occurring, other types of collateralized lending that are much more attractive. And that's where we're focused on, at least for now. But the amount, just the sheer amount of debt that has to be financed here over the next several years is absolutely staggering.
Greg, fantastic. Thank you so much for your insights. Greg Peters, co-CIO for Public and Private Fixed Income at PGIM. We have more ahead on the Asia trade. This is Bloomberg.
Commerce Secretary Howard Lutnick says the US is expecting a large investment pledge from Taiwan in upcoming trade talks. Taiwan's President Lai Ching-te, however, outlined areas that need improvement before investment projects can be completed. Let's get to Taipei now and our executive editor for Greater China, John Liu. So, John, tell us about the spend that the US is expecting and if there's any strings attached.
Well, sort of the idea that Secretary Lutnick put out there overnight was that the U.S. is looking for an investment of somewhere north of $300 billion U.S. dollars. You talked there, Paul, about President Lai's response, speaking at a different forum overnight in the United States. He brought up the issues of can there be enough water? Can there be enough electricity? Will there be the immigration processes in place to allow Taiwanese companies like TSMC to build those factories, to make those investments? And so I think all of those are hallmarks of an ongoing negotiations that I think both sides are keen to come to an end, but still the ultimate end is we have not yet seen.
Yeah, because we don't want a repeat of the immigration raid, which affected South Korean companies operating in the U.S. But John, we are also watching for what we see out of the Macron-Xi meeting. What are we expecting on the issue of Taiwan from that?
Well, the last time that President Macron visited Beijing, he got into a bit of a controversy when his comments seemed to suggest some limits on how much support France would provide to Taiwan. And so now, as he's making this visit this week, again, Taiwan is in the headlines with the comments that we've had from the Prime Minister of Japan and the Chinese response to those comments. And, of course, the Chinese effort to try and get France to voice some support for its position, which is obviously that China sees Taiwan as a domestic issue, not an international issue, and that is why it has objected so strongly to the Japanese Prime Minister's comments suggesting that Japanese troops could be used in a potential conflict over Taiwan. Will President Macron make a comment of that nature? I think it's highly unlikely. I think he will try to stay out of that controversy. I think he's got much more of a focus on economic issues when it comes to trade. Obviously, Europe has levies, tariffs on Chinese EVs, and China has in turn put in charges on French dairy, French cognac, and those are issues I think that President Macron has much more on his plate.
Yeah, let's talk a little bit more about that. President Macron trying to extract some concessions around Chinese levies on pork and dairy products as well. How likely is he to achieve that, and what is China likely to extract in return?
I think often the Chinese way of doing business is to try and seek some sort of strategic interest. Things like dairy, things like cognac and French pork, those are relatively tactical issues, sort of short-term specific issues that the French would like to be resolved. And I think ultimately, or the thing that the Chinese side would like most is, again, that some sort of commentary from the French president limiting support for Taiwan. I think that's unlikely, and so I think that makes a very straightforward deal more challenging, although I think there is a continued effort, and I think the French are very interested in opening Chinese markets.
All right, Bloomberg Executive Editor for Greater China, John Liu there. Other headlines that were following: France is urging the EU to adopt rules requiring car makers to assemble electric vehicles within the region. The country's finance ministry wants EVs sold in Europe to include 75% locally sourced parts to prevent job losses in the industry. This comes as European nations continue to propose measures during the bloc's review of CO2 fleet emissions. The European Union has proposed two options to replenish Ukraine's war-strained budget. One is a loan backed by frozen Russian assets, or one guaranteed by the bloc's own finances. Belgium has already rejected the Russian assets plan, citing concerns it could be forced to repay the loan alone. These developments come as the EU looks for ways to fund Ukraine after the US withdrew its support. Russian news agency Interfax says President Vladimir Putin will begin his India state visit with a closed-door meeting with Prime Minister Narendra Modi. Putin is arriving in New Delhi later on Thursday, marking his first trip to the nation since Russia's invasion of Ukraine. The visit is expected to underscore the two countries' defence and energy ties, and it comes as India still struggles to finalise a trade deal with the US. Avril.
Yeah, that's certainly going to be front and center when the Russian president visits India. But we are also watching for some of these other geopolitical developments related to Russia's talks with US, which didn't amount to much, in relation to some form of agreement when it comes to the Ukraine invasion. For the moment, we are also tracking how Euro Stoxx 50 futures, despite Europe stocks actually finishing the session quite flat amid these AI jitters that we saw also in the US, they're pointing to some upside. So among the things we are tracking in the session. More ahead on the Asia trade, this is Bloomberg. Here are the top global headlines we're following. Bloomberg has learned that President Trump's aides are weighing Treasury Secretary Scott Bessent for a dual role as top White House economic advisor. Leading the National Economic Council would give Bessent oversight of Trump's economic agenda and a West Wing office. Trump has hinted Kevin Hassett will be named Fed chair, but says he'll wait until early 2026 to make the announcement. Meanwhile, Bessent says he'll push for a rule requiring candidates for regional Fed presidencies to have lived in that district for at least 3 years. He says the rule may need congressional approval or could be implemented by the Fed chair and board. Bessent's campaigning for a sweeping shakeup of the central bank, which he accuses of straying from its core mandate of setting monetary policy. Let's take a look at how we're faring cross assets in the U.S. when the Wall Street session. We did see a bounce, but it was not led by the tech names. Futures pointing flat. The dollar is picking up just a touch following its steepest decline or worst session since the middle of September. And of course, looking at the 10-year yield, it's interesting to be nudging towards the 408 handle in the Asia session poll.
Yeah, some interesting moves in bonds today as well. Take a look at what's going on in Australia and Japan. Meanwhile, a few thresholds been broken here. We've got the Japanese 10-year above 1.9 for the first time since 2007. We do have another test of Japan's bond market today with an auction of those longer-dated 30-year notes. Here in Australia, meanwhile, we've got the 3-year. That's cracked 4% or 4.01 for that's now the highest since mid-January, and the 10-year yield also rising 3 basis points. It's pulled back a little bit, 4.66 now, but that's still the highest level that we've seen since November last year. All right, we have more to come on the Asia trade. This is Bloomberg. Right, we've got trade numbers out of Australia for the month of October as a very narrow miss, not by much though, trade surplus of 4.3 billion, let's call it 4.4. The market was expecting a surplus of 4.5 billion. We're seeing a little bit of an increase in the Aussie dollar there, not by much, however. Exports expanding a little bit slower than the month prior, 3.4%, as opposed to the 7.9 we saw in September. Imports jumping, though, to 2%. Sharper increase than 1.1%. We've also got a revision of the September trade balance, a little bit lower, 3.7.
Well, Paul, on top of Australia data, China property sector, that's also been back in focus. And later today, Country Garden is expected to receive approval from a Hong Kong court for its offshore debt plan after more than 2 years of restructuring talks. Meantime, sources say at least 3 investors in a Vanke bond maturing this month have signaled they'll oppose a plan to delay repayment. And New World failed to secure full support from creditors in a key bond exchange plan that required them to accept cuts in the value of their holdings. Let's bring in Serena Zhou, senior China economist at Mizuho Security. Serena, great to see you. So I've just talked through some of the distressed developers in mainland China, but what is your sense of whether we are in a new phase of the property downturn in China?
Yes, actually we are a little bit worried about the accelerating slowdown in China's property sector. If there's no signs of stabilization sometime early next year, then it might pose a significant downside risk to China's growth outlook next year. So naturally, when you have this worsening in the property sector, you would expect banks to lower interest rates for both home buyers and property developers, and you would expect local governments to repurchase idle land and unsold new homes from developers. But actually, we see quite limited policy from both perspectives. And eventually, this burden of supporting the property sector will fall on the shoulder of the central government, asset management companies, which are state-owned ones, and also policy banks. Luckily, the Central Economic Work Conference is just around the corner, and we might see some supportive measures announced after that. If not, probably things will get worse before they get better.
Serena, I wonder if you could weigh in on this, because Vanke is seen as a developer that enjoys a sort of in China. What is your sense of whether we might see backstops specifically for them?
Yes. So as I said, actually, right now for banks, the net interest rate margin, which is a major indicator for bank profitability, has fallen below 1.4% for major Chinese banks, and this is below the well-received international red line of 1.8%, and suggesting there's very limited room for banks to cut rates further or to add those property developers who is on the edge of bankruptcy. And also for local governments, we think they will prioritize their resources to resolve their hidden debt this year, as Beijing has requested local governments to exit all of their LGFVs by June 2027. In that sense, there is not much room for banks to significantly lower their lending rate. There isn't much room for local governments to come in to add it. So probably going forward, maybe cheap loans provided by policy banks, and also asset management companies may come out to acquire assets that can help to improve the liquidity condition for those property developers, as what China has done in late 1990s after the Asian financial crisis.
We've still got housing inventory in China hovering around record highs. So how challenging is it to stabilize the market in this sort of environment? And do you think the worst is over for the property market in China, or are there potentially some bigger challenges to come?
Yes, for the market sentiment, actually, according to a latest survey by the PBOC, like the ratio of households believe that the property price will be lower in future is still quite high, probably at a record high. And in that sense, and also including the home mortgage rate, although it has fell for somehow, now currently at slightly below 3%, but this is still like significantly higher than bank deposit rate, higher than CGB yields, and so like going forward, we believe it's possible for the central government to give some subsidies to households for interest payments. In addition to those subsidies for trade-in consumptions.
So potentially some subsidies on the way. Do you anticipate any other measures coming from the central government in 2026 to not just support the housing market, but also support consumer sentiment more broadly?
To be honest, I always so in addition to those subsidies provided by the central government, we still believe there should be more support from the central government to local governments, as local governments have always been an important growth driver for domestic growth. As I said earlier, like if local governments prioritize all their resources to resolve their hidden debt, there will be less resources allocated to household living, like social. So in that sense, I still believe central government should step up its fiscal transfer or more favorable fiscal policies for local governments. So like for local government to grant better guarantees, livelihood guarantees to their local residents.
Serena, we'll leave it there for today. Thank you so much for talking us through some of the considerations, especially when it comes to the property downturn and how that might be affecting the Chinese economy. Serena Zhou is Senior China Economist at Mizuho Securities. Now let's take a look at how China markets are set to fare ahead of the open today. We are looking, of course, at how futures on the A50 looked a bit positive, so maybe we see a bit of a bounce today as well. Of course, keeping track on the yuan that has continued on its path of gains. Our senior Asia equities reporter, Abhishek Vishnoy, joins me now. So, Abhi, when it comes to China stocks and the amount of risk-taking, I mean, we've just heard from Serena. She's talking through some of the troubles in the property market, how that might affect the economy. What is the calculus for a Chinese stock market investor?
Well, if you look at the setup right now for today, like you said, there might be some gains because Asian stocks are also gaining. But if you talk about the long term, look at the valuations at about MSCI China is at about 12 times. There's nothing home to write about earnings revisions. And in terms of earnings growth, it's like 10% or 14% sort of growth. So, it's the outlook for next year or the medium to short term is middling returns, unless there is a big catalyst in terms of stimulus coming in. In the last few weeks, the market have sort of have gotten really well correlated with macro indicators like PMIs and other economic data, which is softening. So as the macro data is softening, Chinese equities are softening. CSI is down about 5% in that period. And if you look at MSCI China, I think it came very close to correction and it's almost there. So in that context, you can expect market to probably do better today, but the setup looks pretty weak as long as macro data disappoints. We need more stimulus. Let's see what CEWC offers in midweek December. I think last year there were some announcements on more debt and more rate cuts. Hopefully there would be more stimulus and market would find its way out of this sideways to profit-taking kind of mode that it has been stuck since, I think, early October.
What's changed, though? Because earlier parts of the year, we did see how markets were running ahead in spite of the fundamentals, in spite of the lack of stimulus. So why, as we enter 2026, are things looking a little different?
That's a good question. I mean, what happened? Why China markets rallied at that point in time was largely because investors re-rated the market. So price to earnings ratio became the lead indicator for earnings outlook. PE got re-rated because of DeepSeek moment, innovation in biotech, and, this newfound peace between US and China, or at least a lapse of these tensions. PE got re-rated, but the earnings are yet to follow up. They are coming in parcels, but they're yet to follow up. And now, if you add the weakening of macro picture into this not so great earnings picture, that is why markets have been trickling down. But hey, in the very long to medium term, I mean, it's like a breather. It's like a marathon. Market had run so much that it needs a pause. So that pause may extend at least in the first half. But if there is a big stimulus, if there is a big improvement in macro numbers, market would like to re-rate itself further.
Okay, we wait for the next catalyst when it comes to Chinese markets. Abhi, thanks so much. Our senior Asia equities reporter, Abhishek Vishnoi. We have more hits on the Asia trade. This is Bloomberg.
Japan has surely the demand side. They have the megatronics, but Japan needs to have much better AI technology. Germany, great demand, extraordinary mechatronics. They need to have great AI technology. United States, if we reshort reindustrialize our nation, we will have great demand.
NVIDIA CEO Jensen Huang during a fireside chat on securing American leadership on AI in Washington. Now, while the S&P 500 is back within spitting distance of an all-time high, this time, big tech isn't leading the rebound. This chart shows mid-caps rallying in anticipation of a Fed rate cut, with pharma and biotech stocks among the top performers. And we're seeing a similar trend in Japan, where the semiconductor sector has lagged over the past month as concerns mount over AI-related valuations. Meanwhile, bets that the BOJ will hike rates are driving a rally in banks. Paul?
And we're hearing some more comments on those risks. Anthropic CEO Dario Amodei says some AI companies are taking on too much risk by committing to spend hundreds of billions of dollars, if not more, to develop and support AI systems. He added that the industry faces a real dilemma in balancing the need for costly investments in data centers with uncertainty over how quickly economic value from AI will grow. Morgan Stanley is weighing a so-called significant risk transfer, or SRT, to offload some of its data center exposure. Bloomberg learns that the bank, which is a key player in AI financing, has held early talks with investors about an SRT tied to AI infrastructure loans. Strategists forecast cloud giants will spend about $3 trillion on data center projects through to 2028, with cash flow covering only half, leaving banks vulnerable to overexposure. Well, Microsoft shares fell after a report of weaker demand for some of its AI tools. The information says several divisions have cut quotas for AI product sales increases. A Microsoft spokesperson has denied the report. Let's bring in Sarah Fryer, who leads Bloomberg's big tech coverage. So, Sarah, not true, says Microsoft. What are they saying?
Well, I think this is really an instance of very big ambitions at Microsoft to set targets high and then adjusting to the reality that change is going to take longer than they anticipated, or the sales were. So I think that they're, as they deny the report, it's a little bit talking about two different things, because there is still high demand at Microsoft. There still is a big backlog for cloud clients, things that customers want them to do that they are trying to fulfill. At the same time, maybe it's not moving as quickly as their highest hopes. So I think that's what we're gleaning from the information report and some of the backlash to it.
Yeah, so is there enough demand to support all this AI capex, this build out that we're seeing issues and things that might not see returns for years to come?
I mean, that's the multi-trillion-dollar question, right? I mean, there's so much in the economy that's hinging on this large return on investment for all of this money that's been put into data centers, into chips, infrastructure, and hiring. We are seeing some of the biggest competitive poaching events that we've seen in a while. So I think we have, a lot of bets that are significant from the companies, and the application of these technologies, it may not happen as quickly as Wall Street is looking for. Organizations are not technology; they're human operations, and they require a lot of people to agree to adapt how they work, and that is not going to be as speedy as the investment.
Sarah, on the topic of competitive poaching, Meta has poached Apple's head of user interface design, Alan Dye. Tell us about the significance of this hire.
It's hugely significant because Apple really has cultivated that reputation for being a leader in design, and to have their design leader join Meta, which doesn't really have a household name around hardware yet. They're really trying with their Meta Ray-Bans, they're trying with their Quest devices, but this is a moment where they're indicating with this big hire, giving him oversight over a design team at Meta, that they are serious about becoming more of a household name in devices, particularly those that are connected with AI and doing something for you related to Meta's advancements in intelligence.
Sarah, thanks very much for running us through these headlines on all things tech. Bloomberg Sarah Fryer in San Francisco. Some other tech stories we're tracking. Salesforce has issued a better-than-expected revenue outlook for the current period, indicating it's successfully persuading customers to adopt its AI tools. The software provider expects revenue of up to $11.2 billion for the period, ending in January, with a measure of bookings expected to increase by about 15%. But rival Snowflake tumbled in late trade after its operating margin outlook fell short of estimates, raising concerns about the profitability of new AI-based tools. The maker of corporate cloud data software also announced a $200 million partnership with Anthropic, making the startup's cloud AI models available in its platforms. NVIDIA CEO Jensen Huang says he's unsure whether China would accept the company's H200 AI chips if the U.S. relaxes restrictions on sales of the processors. Earlier this year, NVIDIA won approval to sell its less powerful H20 chip in Beijing, designed to fall just below existing export limits. But China promptly told potential domestic customers to shun the product and rely instead on processors made by Chinese companies. We have more ahead on the Asia trade. This is Bloomberg.
All right, let's take a look at how some of these key commodities are tracking at the moment, particularly copper. Let's start there, hitting a fresh record. Copper has seen a surge in orders to withdraw metal from LME warehouses, and that's really adding to some worries that US tariffs could be causing a supply squeeze. Silver, a somewhat volatile metal, doing very well, pushing closer to record highs again, seems to be holding on above that $58 an ounce level. Crude prices a little bit softer today, but natural gas is an interesting one, hitting $5 for the first time since 2022. This is off the back of a forecast for a colder than normal December in the northern hemisphere. In terms of oil, we've also seen US crude inventories rising for a fourth consecutive week. Avril.
Yeah, Paul, cold weather, AI demand, U.S.'s export picture, that's left us with U.S. natural gas futures reaching $5 for the first time since 2022. Steven Stepchinsky, who leads our Asia energy coverage, is here again to talk us through what's at stake. So it's interesting, right? Because the climb in gas prices, maybe not something the Trump administration wants to see.
No, not at all. This is inflationary. Gas is key for a number of industries, but also it's what people use to heat their houses during the winter. This is going to increase power bills. The U.S. has shifted a lot of its power sector to natural gas generation away from coal over the last 20 years because of the shale boom. So you're getting this increase in prices just at a time when the Trump administration wants things to be lower. You know, you're always seeing him talk about inflation. Now, there are a number of factors leading to this increase, right? So it's not just the cold weather, but it's also the fact that another thing that Trump likes to tout, the U.S. has become the biggest exporter of liquefied natural gas. Over the last year, exports have increased 40%. The U.S. is already the world's biggest export, and that's set to continue to increase as another facility called Golden Pass could start early next year. All of that together is really pushing for a bullish environment in U.S. gas prices, and that's why you're seeing that jump recently over the last few weeks. And I think there are questions as how long can this be sustained? Because if this is just about cold weather, you could see this deflate into early next year. But if this is more systemic and producers aren't able to bring back the rigs, and this is about LNG exports rising, then you could see higher prices for longer. And that's something that I think the Trump administration might start to worry about.
Yeah, a really interesting set of dynamics there in the natural gas market. Are things any clearer for the oil market?
You know, for oil, you know, we're heading into a market that is frothy. There's the glut that everyone keeps talking about. And when you speak to analysts from all the way from the IEA to Goldman, they're expecting different variances in the amount of oversupply we're going to be expecting for crude next year. Now, that's a bit of a turnaround for the last few years where prices had been a bit higher, due in part to the war in Ukraine. But also now we're looking into how the Trump administration is trying to broker a peace deal between Russia and Ukraine. And if they are able to broker some sort of deal, now there wasn't a breakthrough in the recent meetings this week, but if there is a deal, then that suddenly means that maybe the Trump administration walks back sanctions on Russian oil. Does that mean more Russian crude enter the market? And overall, you could see a different sort of situation.
Steve, always great to chat. Thank you, Steven Stepchinsky, who leads our Asia energy coverage. That's it from the Asia Trade. This is Bloomberg.